Tersambung bersama kami, Chairman and Managing Member of Great Hill Capital, Thomas J. Hayes. Hello, Hayes. How are you today?
I'm doing well. Thanks for having me, Bram.
Okay, Hayes. If we talk about U.S. Bureau of Labor Statistics announced that inflation was cooler than expected in October. The data also show the annual CPI number below 8% for the first time in 8 months. With this report, will the Federal Reserve or the Fed slow the pace of interest rate hikes in upcoming meetings?
Yes, I think so. What we saw was headline inflation peaked in July at 9.1%. This month came in at 7.7%, which was much lower than expectations of 8% and lower than the previous month of 8.2%. And the month-on-month headline inflation number came in at only 0.4%, which was lower than estimates of 0.6%. So things are certainly moving in the right direction. We saw some relief in used car prices down 2.4%. Apparel was down 0.7%, and medical services was down 0.6%. As well as piped utilities was down 0.4%. So we're seeing relief across the board. What this has done in terms of interest rate hike expectations and why you saw such a big rally in the United States, it's actually lowered the expectations dramatically. If you look at Fed funds futures, which measures the expectations for the December meeting, just one day ago, they expected only a 56% probability of a 50 basis point hike in December. That probability has now jumped to 85.4% probability for the month of December. That will only go 50 basis points as opposed to 75 basis points, which many people thought would be the case after the Fed's most recent hawkish talk. So the data is now lowering expectations. You also saw a situation where the terminal rate from the Fed dot plot at the last meeting was 4.6%. Between that meeting and 2 days ago, people were expecting that terminal rate to go up to 5%, and now those expectations have backed down closer to 4.6% from the dot plot. So when you see the inflation numbers coming down, it means the Fed can start to go more slowly, and the market likes that quite a bit, Bram.
Again, if we look what's the market expectation of the Fed's rate hike at the end of this year and in early 2023, after the inflation report for October, Wall Street moved higher, or investors were optimistic about the good news?
Yeah, I think what you're going to see is, 75 basis point rate hikes are now a thing of the past. I don't think we're going to see any more 75 basis point emergency rate hikes. More likely, if you look at Fed funds futures, you're going to see 50 basis points in December, and then either a pause or a move down to 25 basis points in the following meeting, and then that should be the end of it. So the market's now starting to price in the end of Fed tightening. Whether that ends in December or at the following meeting is unknown. But that will just depend on the data coming in. Before the December 14th meeting, which they're now expected to do 50 basis points, we're going to get two important data points. We are going to get the employment report, the non-farms payroll, on the first Friday of December. So that will be very, very important. And we're going to get another inflation report the day before the next Fed meeting. So that's going to impact how high they go. And if we get another beat like we saw yesterday, it's not outside of the possibility that maybe they only go 25 basis points. That's a lower probability, but at least for now, the emergency hikes of 75 basis points are likely off the table, and they'll be going only 50 and possibly 25 if those data points support it in December.
Okay, Hayes. Fight with rising prices was far from over. CNBC reported that prices in U.S. started rising at an unusually fast pace starting in early 2021, following years of low inflation as the U.S. economy reopened, and a supply-demand imbalance fueled inflation that was initially limited to many items. Has there been a problem in the industrial sector that caused this supply-demand imbalance?
Yeah, we had basically two problems that caused the inflation, Bram. First and foremost was COVID-driven supply-based inflation. So with the shutdowns in Asia, with the shipping bottlenecks, with all the factors that were caused by COVID, you had supply-driven inflation. Then you had the war with Russia-Ukraine that created some energy inflation that compounded things. Then you got some shortage of labor because of all the stimulus in the United States. More people wanted to stay home than go to work. So all of these things came together. But the number one thing that no one's talking about that was the biggest impact on inflation was profligate spending. Certainly in 2020, the need for a couple $1 trillion for the CARES Act was essential to keep people going during the lockdown. But it was the spending, the subsequent spending bills, when we already saw signs of inflation, that they continued to ramp up spending aggressively. $1.7 billion, $1.7 trillion of spending with the Build Back Better program. $750 billion with the Inflation Reduction Act. There's a lot of spending embedded. And most recently, the cancellation of student debt, which was estimated to be about $300 billion. That was struck down in the courts yesterday, so we'll see if that goes through. But the key is, with the election, and I know we're going to talk a little bit about that, as this spending is slowed down and stops, it gives the Fed the ability to fight inflation more effectively. So raising rates while Congress was spending trillions and trillions of dollars is like trying to fight a forest fire with thousands of trees on fire with one single fire extinguisher. And they were ineffective in doing that. And that's why they were panicked with all of these 4 emergency rate hikes in a row. And I think now that spending is going to slow, you're going to see the effects of that tightening kick in very, very quickly. And the Fed may be able to back off sooner rather than later. And markets as a discounting mechanism are starting to sniff that out. And we saw the first taste of that yesterday.
Okay, growing recession worries have hammered Wall Street this year. Are recession fears still haunting financial market in the U.S.?
Well, there's certainly some fears of that. But if you look to the technical definition of a recession, we actually already had one in the first quarter and second quarter of 2022. We had negative GDP. If you look at 2020, the third quarter of 2022, if you back out the one-time export number for mostly energy products, what you'll find is that GDP for Q3 was actually technically negative if you back out those one-time exports. So in theory, we may have already had the recession with 2 to 3 quarters of negative GDP growth. And now the question is, how do things look moving forward? And I think people's concern is that the Fed has tightened so aggressively, so massively, and so quickly. Will that trickle through into 2023? Will earnings continue to come down? And I think the answer is you may see a technical recession, you may see earnings come down, but the market as a discounting mechanism may have already priced most of that in. If you look at the S&P 500, our core index in the United States, it went peak to trough down 25.6% at its worst. The NASDAQ was down close to 35%, the tech-based NASDAQ. So I think a lot of the pain is probably in the rearview mirror, and people, even if earnings start to come down, I think people are going to start to play for the recovery on the back half of 2023, and a strong recovery it can be, provided the Fed follows the data and actually slows down the tightening now that spending is going to slow down moving forward.
Okay, well, so how's your prediction for Wall Street level end of this year, Hayes?
For this year, I think we're going to have some strength into the end of this year. We're at about 3,900 on the S&P 500. I think we could get a year-end rally, a Santa Claus rally that potentially takes us up to 4,100 to 4,250 on the S&P 500. So we could have some serious upside. That's going to be dependent upon the jobs report that comes in the first week of December, as well as the inflation report that comes the day before the Fed meeting. And if the Fed goes less 50 basis points or 25 basis points in December, I think we could get some follow through and have a nice year-end rally with the stock market.
Okay, if we look, inflation was a top concern for voters heading into midterm election, and NBC News poll issued last weekend found 81% of respondents were either somewhat dissatisfied or very dissatisfied with the state of the economy, a level unseen since the 2010 midterm. And if you tell with me, will this condition push the Republican Party to control the Senate?
Yeah, so right now it looks like, the market had expected a red wave, meaning the Republicans would win everything hand over fist. What it looks like right now is it's closer than expected. However, it does seem apparent that the Republicans are going to take the House of Representatives with about, give or take, 225 seats. So a narrow majority, but a majority nonetheless. As for the Senate, the Republicans have about 49. They need 51 to gain control. So the key is going to be the Nevada seat, that's Lakin, and the runoff in Georgia, which is Herschel Walker. So we won't know the results on the Senate probably for some time, but on the House, it does look like the Republicans took control. Why that's so important is the stock market loves gridlock. So the Democrats will no longer be able to continue to aggressively spend, which means the Fed is going to be able to complete their tightening cycle more quickly. It also has implications if the Fed blocks, if the House blocks spending with the Republicans, that they may back off on the aid and the defense spending for the Ukraine, which is going to force both parties to the table and hopefully come to some type of negotiated settlement and peaceful resolution. If that's the case, that would be a huge tailwind for risk assets and actually might bring down the cost of energy in the short term if we could get a negotiated settlement. It's not high probability, but I think as that spending and that support for Ukraine's defense normalizes and comes down a little bit, I think both parties are going to be ready to come to the table and hopefully come to some reasonable resolution, which would be a great thing for inflation, a great thing for the world.
Well, Democrats losing 4 U.S. House seats in New York, is this a sign of the Democratic Party's early defeat?
Well, I think that's true. I think that the Democrats are certainly going to lose the House of Representatives. That's how the numbers are stacking up right now, which creates the gridlock situation. The Democrats did do very good in the governor races, which no one expected. So I think when you saw President Biden out the other day kind of taking a victory lap, it just meant that they lost much less than they had expected. However, they are blocked in Congress, and that's going to be the key thing from an inflation standpoint, from a market standpoint, and an outlook standpoint, because it enables the Fed to start to slow down, take a back seat, because they're not fighting all the new spending and the new spending bills, because the spending is going to stop, and it's going to stop abruptly.
Okay, from this condition, does the market anticipate the worst case scenario where the opposition parties control the House of Representatives so that another government budget gridlock can occur as happened during the Trump administration?
Yeah, I think it's not the worst case scenario. I think it's the best case scenario. Historically, the markets love gridlock, and by the Republicans taking the House and possibly the Senate, it means no major tax regulation can come into effect. No major spending regulation can come into effect. Essentially, it means business is going to be left alone to do what business does best, which is earn money, grow the economy, create jobs, and the market likes that. The other thing that we have is a period of seasonal strength. In the United States, the second year of a presidential cycle is often the worst year, often has corrections that average about 19.6%. We got as low as 25.6%. However, after the midterm elections, that following year is sometimes the best performance in the stock market historically since World War II. And on average, the market's up over 18% in the following 12 months following that midterm election. So not only are we in a seasonal period of strength after October, but we're now in an election cycle period of strength. So for the next 12 months, historically, the market tends to do well. I think this time will be no different.
Okay, and how will the results of the U.S. midterm election impacts the financial markets and the global economy. For example, the Democratic Party controls the Senate and House, or the Republican Party as the opposition wins.
Well, the Republican Party will now have blocking rights now that they have the House and possibly the Senate. And this is going to have two effects. Number one is treasuries. Bonds are going to get a bid, meaning people have been selling bonds all year. People are going to start to buy bonds. We saw it yesterday with the 10-year yield collapsing below 4%. We saw it with the dollar absolutely collapsing. It was the fourth week of losses for the US dollar. That's the longest since 2020. This is great for the stock market, and it's especially great for emerging markets. Emerging markets do the absolute best when the dollar starts to decline. When the dollar is strong, as it has been all year, emerging markets do poorly. When the dollar starts to weaken, historically, emerging markets fly. An example of this is from 2002 to 2007. After the dollar weakened, you saw the emerging market index up 480% over that 5-year period. The same thing happened from 2009 to 2011. After the dollar weakened, you saw the emerging market index up 189%. It happened again in 2016 to 2018. The dollar weakened, emerging markets doubled, up 96%. And then the same thing again from 2020 to 2021. Once that dollar weakened, emerging markets doubled, up 97%. So I think we're going to see that here. And I think the trade of 2023 is going to be dollar weaker, emerging markets stronger. That includes China, which no one would touch with a 10-foot pole in 2022. I think that's going to be a huge opportunity in 2023. Many of the highest quality companies are going to start to get bid. Capital is going to flow as that dollar weakens, and emerging markets can finally flourish. And that's a function of partially the election, because spending will stop. That enables the Fed to stop tightening, which is going to keep the dollar weaker. And that will have a major benefit on emerging markets. China, Indonesia, Malaysia, et cetera, I think will all do well in 2023.
Okay, thank you, Chairman and Managing Member of Great Hill Capital, Thomas J. Hayes. We're hoping the U.S. economy recovers sooner and giving positive impact for global economy as well. Thank you and happy Friday.
Thanks, Bram.